Hey everyone, in this video I'm going to bring you one dividend stock that's down 44% off its high that I think makes an excellent investment for passive income investors in 2024 and beyond. This dividend stock is also yielding nearly 5%. That's an attractive dividend yield for passive income investors, to be sure. So let's jump right in. Let's see what this dividend stock is, why I like it so much, and why I think it's a good investment heading into 2024.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the dividend stock I am talking about is International Paper, which is down 44% off its high in recent years, reached in 2021. Now, I did mention this stock is offering a dividend yield near 5%. It's actually 5.1% to be precise. Now, International Paper has had some struggles recently, and that's mostly due to changing consumer behavior. International Paper benefits when people are shopping online more often because they're ordering more things, and that's good news for International Paper. When people are spending more money on services, as they have been in 2023, that's not such great news for International Paper. Unfortunately, I suspect that 2024 will have people spending more money on away from home experiences, things like services, things like haircuts, barbershops, things like travel, concert, theme parks, all of these things. It's not great news for International Paper, but I think it's a good buying opportunity because longer term, people are going to spend more money online. People are going to spend more money ordering things, and those things are going to be delivered in boxes. It's just in the short term, people are unleashing this pent up demand for away from home services, those types of things, and that's not good news for International Paper. And the consensus analyst estimate agrees with what I'm saying. Let me share it with you. So the consensus is for fiscal year 2024, International Paper's revenue is going to decrease by 2.7% and for its earnings per share to fall by 1.9%. But that's including the fact that it just divested its joint venture and it got back $500 million. So the business is going to be smaller, fewer assets, and that's understandable. It's not like the company's organic sales are going to fall by 2.7%. Now, in fiscal year 2025, analysts expect the turnaround to begin, with International Paper growing 3.4% on the top line and 33.2% earnings per share growth on the bottom line. So things are expected to improve in 2025 for International Paper. From my estimates, I've felt that towards the back half of 2024 is when we will see more normalized consumer spending patterns between services and goods. To begin the year and the first 9 months of the year, I forecast it's still going to be heavier on the services side. And then towards the end of the year, I predict it's going to start normalizing. And then in 2025, I predict a more normalized spending pattern between services and goods. I think at the end of 2020, by the end of 2024, consumers will have unleashed all of that pent up demand to get out of the house, to go to restaurants, to travel, to go to concerts, and all of those things. I think it'll get out of the system. And then by 2025, it'll be the typical balance between the two, like it was in 2019. And looking at the company's cash flow, it did relatively well. If you look at cash flow from operations in the third quarter ended 2023, its cash flow increased to 468 million. That was up from 435 million in the same quarter the prior year. And free cash flow as well improved to 240 million, up from 197 million in the same quarter the prior year. So cash flow and free cash flow is doing well for International Paper. Despite this temporary slowdown in the business, the company is faring relatively well. And then when the rebound happens around late 2024, 2025, International Paper will be in a good position to benefit from that change in consumer behavior. And you're looking back longer term over the last 5 years, cash flow from operations in the trailing 12 months, you can see it peaking out around 2020 and then starting to decrease and ending at 2.1 billion. But that is above the low of below 1.6 billion in late 2022. And it's already started recovering that cash flow from operations. So it's no longer in a downtrend in this metric. The price to earnings ratio. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. That being said, International Paper is trading at a forward price to earnings of 17.37, which is a relatively fair price for this stock. You can see going back all the way to January of 2021, there have been times when International Paper was trading at a cheaper valuation, and there have been times when International Paper was trading at a more expensive valuation. The current forward PE of 17.37 is a fair valuation. It's not too expensive and it's not incredibly cheap. I wouldn't say either of those things. I would just say it's fairly priced. And investors have done well in the long term paying a fair price for good businesses. That's done, if you do that over the long term as a habit, you'll end up wealthier than you were when you began, right? The real risk is paying premium prices for stocks at their peak and expecting that momentum to persist for the long run. That's where some investors get themselves in trouble. Think about all that hype surrounding electric vehicle stocks in 2020 and 2021. Many investments in that category are down 99% off their highs. Investors have lost nearly every single dollar they invested in some of those speculative EV stocks. So that's where the danger lies, in paying these exorbitant prices for these speculative stocks. Paying a fair price for a good business, that's been a reasonably good strategy in the long term for investors. And that's why I'm recommending International Paper as one dividend stock that you might consider adding to your portfolios for 2024. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.